Hey there, future Forex traders. Welcome to the channel where trading gets easy and exciting. Today we're breaking down some of the most common Forex terms you'll hear in my videos. If you're new to trading, don't worry. By the end of this video, you'll understand them like a pro. So grab a snack and let's make Forex simple. Stop loss or SL. Let's start with stop loss. Imagine you bought a box of chocolates for $10, hoping to sell it later for more. But what if the price starts to drop? You don't want to lose too much. A stop loss tells your trading app, if the price drops to $8, sell it right away and stop the loss. It's like a safety net that helps protect your money from falling too far. Now let's talk about take profit. Let's say you bought those chocolates for $10 and you plan to sell them when the price goes up to $12. A take profit tells the system, as soon as the price hits $12, sell it and take the profit. You don't need to watch the price all day. Your trading app handles it for you. Next is overbought. Imagine if everyone suddenly wants to buy the same chocolates, the price shoots up, but eventually there's no one left to buy them. That's overbought. It means prices might be too high and could fall soon. Now the opposite, oversold. Let's say everyone's selling the same chocolates, the price drops fast. At some point it's so cheap that buyers start coming in again. That's oversold. Prices might start going up from there. An uptrend means the market is going up overall. Picture a staircase going higher and higher. Even if it dips sometimes, the overall direction is up. Traders like to buy during an uptrend and ride the wave. A downtrend is the opposite. The market is moving down over time like a staircase going lower. This is when traders look to sell or stay cautious. Now let's talk about pips, one of the most important terms in Forex trading. Pip stands for percentage in point. It's a unit that measures tiny changes in price. Think of it like this. If price is 1.1000 and it changes to 1.1005, that's a 5 pip movement. Still confused? Let's use chocolates. Imagine a box of chocolates costs $1.10, or written as 1.1000. If the price moves to 1.1001, that's 1 pip. If it moves to 1.1005, that's a 5 pip increase. If it drops to 1.0995, that's a 5 pip decrease. Even though it's a small change, in Forex, small moves can lead to big profits or losses depending on your trade size. So think of pips like cents in a dollar. Tiny, but they add up fast. Now this one is super important. Margin trading. Forex trading uses margin. That means you don't need to pay the full amount to open a trade. It's like borrowing money from your broker to control a larger position. Here's a simple chocolate example. Imagine you only have $10, but you want to buy chocolates worth $100. Your broker lets you borrow the extra $90, so you can buy more chocolates than you could with just your money. That's margin trading. It increases your buying power. The good news? You can earn more from small price changes. But be careful, because losses can also add up fast if the market goes against you. And there you have it. These are key Forex terms that'll help you understand my trading videos better and make smarter moves in the market. If this video helped you, don't forget to like, subscribe, and turn on the bell so you never miss a Forex tip. Thanks for watching, and I'll see you in the next video. Let's trade smart and grow together.